On this board, we're talking about TILA. Now, what does TILA stand for? TILA stands for Truth in Lending Act. And which regulation is TILA? TILA is Regulation Z. And what is the purpose of TILA? The purpose of TILA, the purpose of Regulation Z, the purpose of the Truth in Lending Act is to promote the informed use of consumer credit by requiring disclosure about its terms and cost. Another way to think about TILA is that TILA is about credit, APR, and advertising. Now, question for you. Who does TILA apply to? TILA applies generally to creditors who regularly extend consumer credit that is primarily used for personal, family, and household purposes. The lender must extend the credit to a natural person, and the loan must be repayable with either a finance charge or by written agreement in more than 4 installments. Now, when are TILA disclosures required? In general, TILA disclosures are required when credit is offered but before transaction, and when credit is advertised to potential customers. Now, what are some examples of TILA disclosures? Well, we have the LE, and what is the LE? What does the LE stand for? The LE is the loan estimate. Also, we have the CD, and what is the CD? What does the CD stand for? The CD stands for closing disclosure. And as a side note, in general, how long must TILA disclosures be kept? In general, TILA disclosures must be kept for 2 years. However, there are exceptions. One of the exceptions is the LE, the loan estimate. The loan estimate must be kept for 3 years. And another exception is the CD. The CD must be kept for 5 years. Another example of a TILA disclosure is the charm booklet. What is the charm booklet? The charm booklet is the consumer handbook on adjustable rate mortgages. And of course, the charm booklet applies to adjustable rate mortgages, right? So ARMs, as they say, right? Remember that, ARMs, right? What is an ARM? An ARM is an adjustable rate mortgage. Also, another example of a TILA disclosure is when your home is on the line booklets. What transactions does that apply to? Well, that applies to home equity loans, HELOCs, and refinances. Another example of a TILA disclosure is the notice of right to rescind. Now, what transactions does that apply to? That applies to home equity loans, HELOCs, and refinances of principal residence. Now, regarding the notice of right to rescind, right? Every borrower on the loan gets two copies of the notice of right to rescind. And it only takes one borrower on the loan to rescind, and the whole thing is rescinded, right? And if it is rescinded, then the refund of escrow is due within 20 days. 20 days. Now, question. Let's talk about. Oh, by the way, so it's a 3-day right of rescind. So this notice of right to rescind, it's a 3-day right of rescission, right? Once they sign the documents, they have 3 days to rescind, right? Now, let's talk about the APR accuracy and redisclosure. Now, so here's the thing, right? The law is set up so that, you know, these lenders, these creditors are not like changing stuff at the last minute, not trying to trick the borrowers into stuff, right? And so this right here is talking about how if the APR, what is the APR, by the way, right? The APR is the annual percentage rate, right? Annual percentage rate, APR. If the APR changes, right? The APR that was in the initial disclosures, if that changes, right? then if it changes by a lot, then redisclosure is required. All right. Now, what is like the threshold? So basically, it's like this. If the APR changes more than 1/8 of a percentage, which is 0.125%, right? If the APR changes more than 1/8 of a percentage for regular or traditional loans, then redisclosure is required. And if the APR changes by more than 1/4 or 0.25% for irregular or non-traditional loans, then redisclosure is required. Now, let's talk about TILA advertising disclosures, right? Because remember, TILA is about credit, APR, and advertising, right? And TILA is about being truthful, right? It's called Truth in Lending Act, right? We're being truthful, being honest. We don't want to, engage in any type of like false advertising, right? So what we're talking about here is this. Here's the rule, right? If an ad, all right, if an advertisement contains any one of the triggering terms, the ad must also include all of these terms. One, the amount or percentage of the down payment. Two, the terms of repayment. And three, the APR, right? Now, what are the triggering terms that would require these additional terms to be included in the ad? Well, here's some examples of triggering terms. Amount of down payment, amount of any payment, number of payments, period of repayment, and amount of any finance charge, right? So if there's triggering terms in an advertisement, then that advertisement must also include these additional terms, which are the amount or percentage of the down payment, the terms of repayment, and the APR. Now, let's talk about the APR. Again, what is the APR? The APR is the annual percentage rate, right? And another name for APR is the effective rate, Now, keep in mind, the APR, the effective rate, is not necessarily the same as the note rate. And in fact, many times it's not the same as the note rate, right? Because the APR would be the note rate plus all additional fees spread out over the life of the loan. All right. Now, let's talk about ability to repay mortgage rules. That's also called the ATR mortgage rules. The ATR mortgage rules, the ability to repay mortgage rules. So the rules require lenders to make a reasonable, good faith determination that the consumer has a reasonable ability to repay the loan. You see, in the past, there were issues where these like lenders were giving out loans to people who they knew did not have the ability to repay the loan, right? And that's wrong, right? So the law is saying, hey, look, we have these rules now, right? The law says, look, you have to make a reasonable, good faith determination that the consumer has a reasonable ability to repay the loan. Now, here's the question then. How do we make that determination, right? What are some things that lenders need to consider when they are making a reasonable, good faith determination that the consumer has a reasonable ability to repay the loan? So here they are. Lenders should consider these 8 factors. Lenders should consider these 8 factors when considering, when making a reasonable, good faith determination if the consumer has a reasonable ability to repay the loan. Lenders should consider these 8 factors. Number 1, current or reasonably expected income or assets. Number 2, current employment status. Number 3, borrower's credit history. Number 4, monthly mortgage payment for this loan. Number 5, monthly payment on any other loan secured by the property. Number 6, monthly payments for property taxes and insurance. Number 7, other debts, including alimony and child support obligations. And number 8, monthly debt to income ratios. Now, let's talk about qualified mortgages. Qualified mortgages. Lenders are deemed to have complied with ATR requirements if they satisfy the definition of a qualified mortgage, which is also called a QM, a qualified mortgage. So here's the thing. Lenders are deemed to have complied with ATR requirements if they satisfy the definition of a qualified mortgage. So here's some things that a qualified mortgage must have to be considered here are some things that a mortgage must have to be considered a qualified mortgage. Number 1, full documentation. There could be no these no doc loans are not eligible to be a qualified mortgage. Full documentation, meaning we need to verify income. We need to verify assets, right? Full documentation. Also, no excess upfront points and fees, all right? The maximum is 3%, the maximum. So the total upfront points and fees cannot exceed 3% of the loan amount, all right? If it does, then it does not qualify to be a qualified mortgage. Now, a cap on debt to income ratio. The cap is 43%, right? So the debt to income ratio cannot be more than 43%. Maximum loan term is 30 years, 30 years. No prepayment penalties except for certain fixed rate qualified loans. No risky or toxic features. No risky or toxic features. For example, no features like negative amortization, no balloon payments, no interest-only loans, no teaser rates, right? Now, ARMs can be qualified mortgages, but ARMs must be underwritten as a fully amortizing loan at the maximum interest rate that loan can adjust to within the first 5 years, all right? So the ARMs, in order to be a qualified mortgage, right, the ARM must be underwritten as a fully amortizing loan at the maximum interest rate that loan can adjust to within the first 5 years. Now let's talk about HOEPA. HOEPA. What is HOEPA? HOEPA is Home Ownership and Equity Protection Act. And what is the purpose of HOEPA? The purpose of HOEPA is to address certain deceptive and unfair practices in home equity lending. It amends TILA and establishes requirements for certain loans with rates and fees above a certain threshold. So when certain loans have a rate and or fees that are above a certain threshold, then this law kicks in and applies certain requirements, right, that must be followed. So let's talk about 2 types of HOEPA loans, all right? Section 32 and Section 35. Section 32 and Section 35. So Section 32, what is a Section 32 HOEPA loan? Section 32 is a high-cost loan, high-cost loan. Now, a high-cost loan are loans that meet any of this criteria, okay? Number 1, we look at the APR coverage test. APR exceeds APOR. By the way, what is APOR? APOR is average prime offer rate. Average prime offer rate. If the APR on the loan exceeds the average prime offer rate, the APOR, if the APR exceeds the APOR by more than 6.5% on a first lien of $50,000 or higher, then it is a Section 32 high cost loan. If the APR exceeds the APOR by more than 8.5% on a first lien less than 50,000, then it is a Section 32 high cost loan. If the APR exceeds the APOR by more than 8.5% on second lien loan, then it is a Section 32 high cost loan, right? Also, points and fees coverage tests. If the points and fees exceed 5% on loans that are greater than 21,549, then it is a high cost loan, a Section 32 high cost loan. If the points and fees exceed 8% or $1,077 on loans that are less than 21,549, then it is a Section 32 high cost loan. Now, also let's look at the prepayment penalty test. If there's a prepayment penalty charged for more than 36 months after closing, then it is a Section 32 high cost loan. Also, if there's a prepayment penalty charged for an amount more than 2% of amount prepaid, then it is a Section 32 high cost loan. Now, let's talk about Section 35. What is a Section 35 HOEPA, right? Section 35 of HOEPA is about higher price mortgage loan, which is also known as HPML. Now, the thresholds here is this. If the APR on the loan exceeds APOR by 1.5% or more on a first lien, then it is a Section 35 higher price mortgage loan. If the APR exceeds the APOR by 3.5% or more on a subordinate lien, then it is a Section 35 higher price mortgage loan. So we're talking today about TILA, right? And what is TILA? TILA is Regulation Z, and it's the Truth in Lending Act. And the purpose of TILA is to promote the informed use of consumer credit by requiring disclosure about its terms and costs. If you have any questions or comments, please put them in the comments section below, and I'll see you on the next video.